And welcome to Synapse Global Institute. I am your instructor for Advanced Financial Reporting and Analysis, and today we begin an important CPA Advanced Level area, accounting for associates, with particular focus on impairment, applying the principles of IAS 28 investments in associates and joint ventures, and IAS 36 impairment of assets. This topic is frequently examined and tests both technical accuracy and disciplined presentation, so we will approach it carefully, section by section, ensuring that every figure and requirement is fully understood before moving to adjustments, and finally the financial statements. Once again, welcome to Synapse Global Institute. We are given a CPA Advanced Level examination question involving Horizon Limited, a company incorporated and operating in Kenya, with financial information presented as at the 31st of December 2021. All monetary amounts in this question are stated in Kenya shillings thousands, which is important to remember to avoid scale errors when presenting workings and final statements. The question tells us that on the 1st of January 2010, Horizon Limited acquired 35% of the ordinary share capital of Vector Limited. This level of shareholding is critical because it establishes that Horizon Limited has significant influence, rather than control, over Vector Limited. As a result, the investment is accounted for using the equity method in accordance with IAS 28. This immediately signals to us that we will be adjusting the carrying amount of the investment for Horizon Ltd's share of Vector Ltd's profits, dividends, and any other required equity adjustments. Rather than consolidating line by line, we are first presented with the trial balance of Horizon Limited as at the 31st of December 2021. On the debit side, Horizon Limited reports property, plant and equipment of 210,000, an investment in Vector Limited of 70,000, inventory amounting to 46,000, trade receivables of 32,000, and cash and bank balances of 22,000. The statement of profit or loss related debits include cost of sales of 280,000, distribution costs of 32,000, and administrative expenses of 28,000. These figures collectively represent Horizon Ltd's operating structure and cost base for the year. On the credit side of the trial balance, Horizon Limited reports revenue of 420,000, trade payables of 54,000, issued share capital of 150,000, and retained earnings at the 1st of January 2021. Amounting to 96,000. The trial balance totals agree at 720,000, confirming arithmetical accuracy at the initial stage. This trial balance forms the foundation upon which all further associate-related adjustments will be made. The question then provides financial information relating to Vector Limited, the associate. For the year ended the 31st of December 2021, Vector Limited reported a profit for the year of 30,000. In addition, an extract from Vector Ltd's statement of financial position shows net assets of 180,000 as at the same date. We are also told that at the date of acquisition, the 1st of January 2010, the fair value of Vector Ltd's net assets was 160,000. This historical fair value information is important conceptually because it underpins goodwill and post-acquisition movements when applying the equity method. Even though goodwill is not separately recognized in the investor's statement of financial position, further additional information is provided, and each item is highly examinable. First, during the year ended the 31st of December 2021, Vector Limited paid dividends of 12,000. Under IAS 28, dividends from an associate are not recognized as income, but instead treated as a reduction in the carrying amount of the investment, a point that students must handle carefully. Second, Horizon Limited sold goods to Vector Limited during the year at a markup of 25% on cost, and goods invoiced at 8,000 remained unsold in Vector Ltd's inventory at the year end. This introduces the concept of unrealized profit on downstream transactions, which must be eliminated to the extent of the investor's interest. When determining the share of profit from the associate, third, the question highlights that at the 31st of December 2021, adverse market conditions existed, indicating that the investment in Vector Limited may be impaired. This is a clear trigger for applying IAS 36 impairment testing to the investment accounted for under the equity method. Fourth, we are told that the recoverable amount of Horizon Ltd's investment in Vector Limited at the 31st of December 2021 was estimated at 78,000. This figure will later be compared with the carrying amount of the investment to determine whether an impairment loss should be recognized. Finally, the question instructs us to ignore deferred tax, which simplifies the analysis by removing the need for temporary difference calculations and deferred tax adjustments. The requirements of the question are extensive and structured. We are asked to determine Horizon Ltd's share of profit of Vector Limited to be recognized in profit or loss, the carrying amount of the investment before impairment, the impairment loss if any, the carrying amount after impairment, and then to prepare both the statement of profit or loss and the statement of financial position of Horizon Limited for the year ended the 31st of December 2021. This confirms that the question is not purely computational, but requires full financial statement presentation consistent with CPA Advanced Standards. In the next section, we will move into the adjustments, where we shall compute the associates' adjusted profit, deal carefully with unrealized profits, dividends, and apply the impairment test under IAS 36 with clear, step-by-step reasoning. Only after that will we proceed to the consolidated final financial statements, ensuring everything ties back logically and numerically. Let us now proceed to the adjustments, where we translate the facts of the question into accounting numbers in accordance with IAS 28 and IAS 36. At this stage, our objective is not yet to present final statements, but to understand how each adjustment arises, how it is computed, and why it affects either profit or the carrying amount of the investment. We begin with the operating performance of Horizon Limited itself, before considering the associate. From the trial balance, Horizon Limited generated revenue of 420 million shillings. Against this, cost of sales amounted to 280 million shillings, leaving a gross profit of 140 million shillings. When distribution costs of 32 million shillings and administrative expenses of 28 million shillings are deducted, the operating profit of Horizon Limited for the year is 80 million shillings. This operating profit represents the performance of Horizon Ltd's own operations and is the base figure to which the share of profit from the associate will later be added. We now turn to the associate adjustments under IAS 28. Starting with the issue of unrealized profit on downstream transactions. Horizon Limited sold goods to Vector Limited during the year at a markup of 25% on cost. A markup of 25% on cost translates into a profit margin of 1/5 on the selling price, because profit of 25 on cost of 100 gives a selling price of 125, and 25 divided by 125 equals 1/5. At the reporting date, goods invoiced at 8 million shillings were still held in Vector Ltd's inventory. The unrealized profit embedded in these unsold goods is therefore 1/5 of 8 million, which is 1,600,000 shillings. This profit has not yet been realized from a group perspective and must be eliminated when determining the associate's adjusted profit, because this is a downstream sale, meaning the sale was made by the investor to the associate. The full unrealized profit is removed from the associate's reported profit before calculating the investor's share. Vector Ltd's reported profit for the year is 30 million shillings. After deducting the unrealized profit of 1,600,000 shillings, the adjusted profit of Vector Limited becomes 28,400,000 shillings. Horizon Limited owns 35% of Vector Limited, so its share of this adjusted profit is calculated by applying the 35% holding to the adjusted figure. 35% of 28,400,000 shillings amounts to 9,940,000 shillings. This is the figure that Horizon Limited recognizes as its share of profit of the associate in its statement of profit or loss. We then consider dividends received from the associate, which is a common area of error in examinations. Vector Limited paid dividends of 12 million shillings during the year. Horizon Ltd's share of these dividends, based on its 35% holding, is 4,200,000 shillings. Under IAS 28, dividends received from an associate are not treated as income. Instead, they represent a return of part of the investment and therefore reduce the carrying amount of the investment in the associate. This distinction is critical because recognizing dividends as income would result in double counting of the associate's performance. Next, we compute the carrying amount of the investment in Vector Limited before impairment. Horizon Limited initially recognized the investment at cost of 70 million shillings. To this, we add the share of adjusted profit for the year, which is 9,940,000 shillings. From this subtotal, we deduct the dividends received of 4,200,000 shillings. The resulting carrying amount of the investment, before considering impairment, is 75,740,000 shillings. This figure represents Horizon Ltd's updated equity accounted interest in Vector Limited as at the 31st of December 2021, before applying IAS 36. We now apply the impairment test under IAS 36, prompted by the adverse market conditions described in the question. The recoverable amount of the investment has been estimated at 78 million shillings. IAS 36 requires us to compare the recoverable amount with the carrying amount of the asset. In this case, the carrying amount before impairment is 75,740,000 shillings, while the recoverable amount is 78 million shillings. Because the recoverable amount exceeds the carrying amount, there is no impairment loss to recognize. Accordingly, no impairment expense is charged to profit or loss, and the carrying amount of the investment remains unchanged after the impairment review. Finally, we determine the profit for the year attributable to Horizon Limited, incorporating the associate. The operating profit from Horizon Ltd's own operations is 80 million shillings. Adding the share of profit from Vector Limited of 9,940,000 shillings gives a total profit for the year of 89,940,000 shillings. This figure will flow into retained earnings and ultimately into equity in the statement of financial position. At this stage, all key adjustments relating to the associate and impairment have been completed and fully explained. In the next and final section, we shall use these adjusted figures to prepare the statement of profit or loss and the statement of financial position of Horizon Limited in proper CPA Advanced examination format, ensuring that all balances reconcile logically and numerically. We now proceed to the final section, preparation and explanation of the financial statements of Horizon Limited, using the adjusted figures we have already computed. At this stage, nothing new is introduced. Our task is to organize the numbers correctly, explain their placement, and demonstrate how the statements flow from the trial balance and the associate. Adjustments in a manner expected at CPA Advanced Level. We begin with the statement of profit or loss for Horizon Limited for the year ended the 31st of December 2021. The statement opens with revenue of 420 million shillings, representing the total sales generated by Horizon Limited during the year. From this, cost of sales amounting to 280 million shillings is deducted, resulting in a gross profit of 140 million shillings. This gross profit reflects the core trading performance before operating expenses, distribution costs of 32 million shillings, and administrative expenses of 28 million shillings are then deducted. These expenses represent selling, marketing, and administrative overheads incurred during the year. After deducting these costs, Horizon Limited reports an operating profit of 80 million shillings. This figure represents the profit generated purely from Horizon Ltd's own operations, before taking into account the performance of the associate, below operating profit, Horizon Limited recognizes its share of profit of the associate, Vector Limited. As established in the adjustments section, the share of adjusted profit attributable to Horizon Limited is 9,940,000 shillings. This amount is presented as a single line item, in line with IAS 28, rather than being merged with operating income or expenses. When this share of profit is added to operating profit, the profit for the year amounts to 89,940,000 shillings. This is the final profit figure attributable to Horizon Ltd's shareholders for the year. We now move to the statement of financial position of Horizon Limited as at the 31st of December 2021, starting with assets. Under non-current assets, property, plant and equipment is reported at 210 million shillings, as per the trial balance, with no revaluation or impairment adjustments indicated in the question. The investment in the associate, Vector Limited, is shown at 75,740,000 shillings. This figure reflects the original cost of the investment, increased by Horizon Ltd's share of Vector Ltd's adjusted profit, and reduced by dividends received, with no impairment loss recognized following the IAS 36 assessment. The total non-current assets therefore amount to 285,740,000 shillings. Current assets are then presented. Inventory is reported at 46 million shillings, trade receivables at 32 million shillings, and cash and bank balances at 26,200,000 shillings. The cash balance reflects the opening cash for the trial balance plus the cash dividends received from Vector Limited during the year. When these current assets are added together, they total 104,200,000 shillings. Combining non-current and current assets gives total assets of 389,940,000 shillings. We then consider equity and liabilities. Equity comprises share capital and retained earnings. Share capital remains unchanged at 150 million shillings. Retained earnings are updated from the opening balance of 96 million shillings by adding the profit for the year of 89,940,000 shillings. This results in closing retained earnings of 185,940,000 shillings. Total equity therefore amounts to 335,940,000 shillings. Liabilities consist solely of trade payables amounting to 54 million shillings, as per the trial balance, with no additional liabilities introduced by the adjustments. When total equity of 335,940,000 shillings is added to trade payables of 54 million shillings, the total equals 389,940,000 shillings. This agrees exactly with total assets, confirming that the statement of financial position balances. To conclude, this question demonstrates the integrated application of IAS 28 and IAS 36 within a full set of financial statements. It tests the student's ability to distinguish between operating performance and associate results, eliminate unrealized profits correctly, treat dividends as a return of investment, and apply impairment principles logically rather than mechanically.